Good afternoon, everyone. Thank you for joining us at the Corporate Connect webinar, which is jointly organized by SIAS and supported by SGX. My name is Zach and I'll be your MC for this afternoon. A warm welcome to OUE Commercial REIT, who will be doing a corporate presentation for us this afternoon, as well as our audience from Facebook Live. We will kick off today's webinar with a pre-recorded presentation by Ms. Amelia Tan, research analyst from SGX on recent market highlights, followed by a presentation by Mr. Han Kim Siu, Chief Executive Officer and Executive Director of OUE Commercial REIT Management Private Limited. We will end off with a Q&A session moderated by SIAS. A little background about OUE Commercial REIT. It is listed on the main board of the Singapore Exchange since 27 January 2014, and OUE Commercial REIT, also known as OUE-C REIT, is one of the largest diversified Singapore REIT with total assets of 5.8 billion as at 30th June 2022. With 7 properties across the commercial and hospitality segments in Singapore and Shanghai, OUE Commercial REIT property portfolio comprises approximately 2.2 million square feet of prime offices, retail space, as well as 1,643 upper upscale hotel rooms. So this afternoon, we'll get to hear from Mr. Han on their company's latest business performance and also financial results. Before that, let us get into this pre-recorded session of Ms. Amelia Tan from SGX on recent market highlights. Thank you.
Hi everyone, thanks for joining us this afternoon. Myself, Amelia from the SGX research team. I'll be giving everyone a run through of some of the market highlights and also a little bit of our REIT sector before I pass the time over to Mr. Han from OUE Commercial REIT today. All right, moving over to the next slide. We'll have to just display this a little bit, standard disclaimer, before we start with our presentation. Okay, now moving on to the next slide, I wanted to talk a little bit about the STI in 2022. For those of you that have followed some of the SGX research content, you may have noticed that we've been talking about STI's performance in 2022. Now, first and foremost, STI led the developed economy benchmarks in 2022 and in fact was one of the best performing benchmarks globally, just after I think some of our indices like the ones at the bottom you see over here. But if not, in the developed markets, we've been the best performing index, gaining over 4% in price and also 8.4% in total returns, including dividends. Whereas if you look at the bottom right chart, the FTSE Developed Index generated declines on average of about close to 20%. Regionally, across the other regional benchmarks on the bottom left, we've also generally outperformed. So the Singapore market as a whole was perceived as a safe haven or shelter in the storm given its resilient performance in 2022. A couple of reasons why so. Some of the key factors or key drivers, if you will, were attributed to factors such as the benchmark composition of the STI itself. Now, STI today, it has over 45% of its weight to banks. And as we all know, banks have been beneficiaries of higher interest rates. On the flip side, STI has generally a lower exposure to the technology sector, which was also impacted by higher interest rates that have seen value stocks being less favorable over the past year. Okay, whereas if we can see some of the other markets, generally they've higher technology exposure and hence slightly more impacted by interest rates. Now, the second theme that has also been a key driver for our STI is also the Singapore transformation theme across some of our Singapore listed stocks. STI has got many stocks that pressed on for the rest of the bulk of 2022. They've pressed on with the strategic initiatives. For example, Singtel, they saw their net profit boosted by $1 billion in terms of exceptional gain. This was largely due to the divestment that they made in Airtel. Keppel Corp also saw them continue to accelerate with its transformation under its Vision 2030 goal. For city developments, just to name a few names, they've also continued to accelerate with its growth, enhancement and transformation strategy. So a lot of these Singapore Inc. transformation theme played out across some of our STI stocks. And not to mention, the whole of last year, we've seen the broader regional reopening theme and also some of the global economic themes that were largely in play. Okay, with that, let's move on to the next slide. I just want to talk a little bit about the outlook and also a bit of a look ahead for 2023. Now, 2023 started out rather optimistic, especially in January. We saw STI gain about 3.5%, and this was boosted by optimism from the global reopening theme. And also at the start of this year, there were some expectations of potentially a slower pace in rate hikes this year. Now, we saw Fed have a few meetings subsequently, and they've also telegraphed that inflation is still a key problem that they are tackling, and they've also vowed to deal with the inflation topic. And so with that, the street does expect, and the Fed also expects, likely that the interest rate hikes will continue throughout the rest of this year. Okay, it's only as of now, February, we've still got another 10 months to go. Despite that, interest rates and inflation, they continue to remain very topical this year, and markets and investors are definitely going to keep a very close watch on the numbers. Now, that being said, there are key drivers for the market this year, especially within the context of Asia and also for Singapore. Now, first and foremost, 2 weeks ago, we saw government announce that we're finally, Singapore, entering the DORSCON green level after 3 years of mask wearing and COVID-related measures will also be removed. Now, this move will further emphasize the reopening theme that's been in play in sectors such as retail, hospitality, events, travel and leisure in Singapore and also within the region. Now, not just Singapore moving to the DORSCON green level, China has also relaxed its COVID-19 measures at a much faster pace than expected. And together with some of the various measures to support the property sector, it would seem that the Chinese authorities are also prioritizing growth, which could provide a much needed boost to the global economy. And in fact, investors and the market are positive on Asia's growth in the coming years. Okay, the OECD, which is the Organization for Economic Cooperation and Development, in a recent study, they've also published that, they predict Asia will be the main growth driver in the next 2 years, despite slower growth. And also, I don't know whether you guys may have seen the study and a recent survey conducted by the Investment Management Association of Singapore, IMAS. They published a few weeks ago. The survey showed that fund managers in Singapore are upbeat about Asian equity and credit markets in 2023, especially within the Asia ex-Japan region. And majority of these fund managers are expecting a 10 to 20% recovery in equities. And some of the sell-side broker houses are also encouraging the pivot to companies with more resilient earnings. And these likely will be the ones that will benefit from the global reopening theme and the festivities that we've seen at the end of last year, early this year, and in particular, some of the ASEAN consumer names. Again, perhaps that's a reason why we saw STI return about 3.5% in January alone, and Singapore REITs gained 7% in January. Okay, with that, we'll move on to the next slide. I wanted to talk a little bit about REITs in general before we talk about S-REITs today. So REITs in general, this slide, there's a chart over here. Just have to follow me as I sort of walk through this slide, okay? This slide was taken from one of the studies that looked at investments across various asset types, covering over about 200 public and private sector pensions. Okay, and results from the study shows a few things. Number one, REITs as an asset class, they've generated the second highest average annual returns across these 12 asset classes over here. Some of the other observances also showed that REITs in general as quite a unique asset class and has a low correlation with the other asset classes such as equities. Okay, and therefore REITs had also generated the highest non-fixed income risk-adjusted returns. And therefore, given its unique characteristics as an asset type of its own, REITs continue to be a part of asset allocation in investment portfolios today across investor groups. All right, and the next slide shows a little bit of S-REITs performances against some of the major global REIT markets, like there is Hong Kong, Australia, US, and also Tokyo, some of the colored lines. The white line that you see is the S-REIT index. Okay, so this graph shows that S-REITs, which is the white line, versus the other global REIT markets in the colored lines, S-REITs have outperformed consistently and over the longer term. And even with the recent dip in years, due to the higher interest rates, S-REITs have also remained fairly resilient compared to the other REIT markets. All right. For the whole of 2022, S-REITs returned about negative, declined about 12%, whereas global REITs declined as much as 25 to 30%. Okay. And also in terms of S-REITs distribution yield, which is what investors also look at, because S-REITs generally as an asset class, they do distribute regular dividend payments to investors. S-REITs distribution yield is also one of the highest compared to some of our other REIT markets. Now, moving on to the next slide. This is a slide that I've taken from our monthly REITs chart book. Those of you that's interested, do go to sgx.com/research. Our S-REIT chart book is there on a monthly basis. It gives you statistics, highlights, all you need to know about the sector. Okay, so this slide is from that chart book, and a few things that I wanted to cover over here as a broad intro to the market is that we've got 42 actively traded REITs. In total, this segment makes up about 100 billion of our total market cap. That forms about 12% of the overall market cap of the companies that are listed on SGX. As a sector, S-REITs are also very liquid. In fact, close to a quarter of the daily turnover you see on the exchange is churned from S-REITs. In terms of regulation, S-REITs are also governed under the SIAS, what we call it as the Collective Investment Scheme, and is well regulated too. For example, each of the REIT must be professionally managed by a manager. The gearing, which is the debt to asset ratio, the maximum that it can go up to is up to 50%. REITs also must have distributions to unit holders, and also they benefit in terms of the tax efficiency. Okay, and in terms of diversity, I wanted to point everybody to the two pie charts on the right. S-REITs, a few myths that I like to dispel. Number one, you invest in S-REITs means investing into Singapore property. It's not true, because we have many S-REITs, in fact, with pure overseas assets. We've also got a big bunch of S-REITs that have a mix of Singapore and overseas assets. Pure Sing assets, we only have 3 REITs over there. And the second myth that I wanted to also dispel is S-REITs, invest in traditional sectors like shopping malls, logistics, warehouses, office buildings, hotels. But it's not necessarily true, because on the top right-hand corner, you can see that we have various other asset classes that our REITs have also diversified into. In fact, now we are seeing some of our REITs moving into new economy sectors like data center REITs, some of the those grocery, in US, they have all the grocery anchored malls. Yeah, and I think some of the REITs are also looking at student accommodation assets and even potentially self-storage hubs. Okay, and over at the bottom right, that gives you a sense on some of the trusts that have pan-Asian exposure. So wherever you're looking at in terms of getting some exposure into that kind of property in that area, there are some S-REITs for you to also look at as well. All right, now let's move on to the next slide. The next slide, this shows a correlation matrix between S-REITs and other asset classes. Okay, based on the data, as you can see, we ran the data for the last 10 years, from January 2012 to December 2022. Our REIT indices, which is the first 2 rows, FTSE ST REIT Index and also the IHS REIT Index, generally have lower correlation to the other asset classes that you see towards the right, equities, bonds, and even global and US REITs. And because of its low correlation to the other asset classes, this forms opportunities for investors for asset allocation and to diversify investor portfolio types. Okay, moving on to the next slide. Just a very brief walkthrough on this. S-REITs, our average distribution yield to date is about 7.6%. This is higher than the SCI index's distribution yield, also higher than the core inflation rate published by the MAS and also the 10-year government bonds, just to give a sense in terms of where we are with things today. Now, moving on to the next slide. This slide, it shows a few things, but I'm going to walk you guys through this slowly, okay? So historically, the S-REITs have an average yield spread of around 380 basis points. The yield spread today is at around 300 basis points. The driver for this is also because interest rates have been higher. right? But our S-REITs have also been proactive in a few areas when they're trying to grow their DPU. For instance, through accretive acquisitions. In fact, over the last 2 years, we've seen our S-REITs meet acquisitions and mergers. In terms of acquisitions over the last 2 years, our S-REITs have a combined acquisition of about over $18 billion in terms of the acquisitions that they've made. And a lot of this is to grow the AUM that they have and also to generate higher DPUs for the unit holders. Aside from that, capital recycling initiatives are something that REITs also actively look into. For example, divestment of assets and also the asset enhancement initiatives, for example, to enhance the yields that they can generate back to the unit holders. From a valuation perspective, where are we in terms of REITs today? If you can look at the chart on the right, okay, I'll walk you through this. Now, the green line is the index price to book ratio. As you can see, currently the index price to book is around about 0.9 times, which is below the historical average of about 1 times. Okay, so in terms of valuation, it's not too demanding as well. Now, in terms of fund flows, just to share what we're seeing from the exchange perspective is that, yes, retail investors have been net buyers of the sector for a lot of last year, perhaps taking the opportunity to optimize, revisit their portfolios, and maybe even picking up some of the REITs at lower valuations. But in January, last month, we've seen insti investors coming back into the sector to start, having net buys back into the sector. And this is after many months of institutional net selling the sector from the numbers that we've seen. Okay, that gives a sense of sort of where things are with the sector today. Now, moving on to the next slide, this is where I wanted to talk a little bit about the fundamentals of S-REITs. S-REITs, yes, in fact, not just S-REITs, global REITs. It's been a challenging year for the last 2020 because of the higher interest rate environments. REITs in general across the board have been on a decline in terms of the price performance, as you have seen some of the global REIT markets down, about 17 to 25%. However, our S-REITs have been resilient last year, declining just 12% in total returns versus global REIT markets. And despite headwinds, our S-REITs have also reported solid and resilient fundamentals in their earnings that they've released over the last few earnings releases. They've also talked about how they've been beneficiaries of the regional reopening theme, and especially the return of global travel and some of these large-scale events. And some of the beneficiaries that we've seen, right, would be in cases like hospitality REITs. They've reported better revenue per available room. They've reported better occupancy rates. Even within the retail space, they've also reported that they're seeing higher shopper traffic and higher tenant sales. Some of these shopper traffic figures and tenant sales are even higher than pre-COVID levels. Office REITs also has been a challenging year for them. Regardless, they've also managed to report positive rent reversions in the last year. And also for logistics REIT, some of the REITs in this space, they see demand is resilient and there continues to be a need for logistics and warehouse space for businesses. Okay, now moving into next year, or rather this year, 2023, what does it mean? So 2023, this year, and I'm on slide 12, which is the next slide, 2023. Okay, we've seen fund flows from insti investors coming back into the sector, and which is why the sector returned 7% in January. In fact, close to doubling STI's 3.5% gains. Just to share a little bit, there are 7 REITs in the STI, and all 7 of them outperformed the benchmark. And the top 5 performing REITs are over here, what I've listed. Keppel DC REIT was up 15%. Mapletree Pan Asia Commercial Trust was up 9%. FLCT was up close to 9%. Mapletree Logistics Trust up 78%. Mapletree Industrial Trust is also up more than 7%. And a lot of this we've seen in January was also driven a lot by the institutional fund flows coming back into the sector after months of net sales. A key driver in this, of course, was what I mentioned earlier on, right? The earlier than expected reopening of China's economy, change in its COVID policies, as well as at the start of the year, there were expectations by the street and by investors, expectations of a slower pace in interest rate hikes. And typically, interest rates, this will affect market sentiments towards interest rate sensitive sectors such as REITs. Then brings me to my last slide, which I wanted to just leave a point with everybody over here. Our S-REITs are very diversified in nature, and diversification is also a key driver in why our S-REITs have been resilient over the past few years. Now, there are two ways I mentioned earlier in terms of diversification. Number one, asset mix. So the type of properties, right? It's not just a single property. Many of them have diversified asset types and asset mix. The second one in terms of diversification is geography. So not just Singapore, they're investing into the region, into other markets, and you also have S-REITs that are purely just investing out of Singapore. Okay, and I talked about acquisitions also. In terms of diversification, you see many of our REITs eventually sort of moving out of Singapore through mergers and acquisitions. And this is ongoing, right? With the 18 billion in acquisitions that we've seen in the last 2 years. And diversification is very important because that helps to improve a REIT's resilience to external shocks and also allows it to capture growth trends across a multitude of segments in many ways. Okay, and here are some examples. On the right is actually one of our REIT Watch pieces that we have on a regular basis. We write about the REITs in a regular Monday column. So catch us over there as we highlight certain interesting points about the REIT sector. But in our recent last 2 weeks, we did publish a piece talking about how S-REITs do see resilience and diversification, do have a read on that. Some examples that we drew references from was, for example, in recent years, CICT was, as a result of the merger of CMT and CCT, to generate a bigger, more diversified commercial REIT in Singapore. CLCT, they've also expanded their mandate recently, right? Now they have a 5-year acquisition growth roadmap that they've embarked on to achieve a more diversified portfolio mix of about 40% commercial, 30% retail, and 30% new economy sectors, for example, business parks, data centers, and also logistics. CapitaLand India Trust, previously as Sanders India Trust, is also another example. They ventured, they have now investments, and they're also developing data centers in India, which is one of the second fastest growing digital economies in the world, based on a McKinsey report. And last but not least, OUE Commercial REIT has joined us today in this session. They also gone through some corporate action a few years ago. They've merged the OUE Commercial REIT together with the OUE Hospitality Trust to create an enlarged diversified REIT today. Okay, and with that diversified REITs, which is what I've highlighted in the pie chart above, they now form one of the largest sub-segments within our S-REIT sector today at about 22%. Okay, and I guess today that's when we probably, I personally myself, I'm looking forward to hearing from Mr. Han from OUE Commercial REIT, one of the largest and diversified S-REITs with total assets of $6 billion across commercial hospitality segments in Singapore and China. And I will look forward to what they have to share with us. So over to you, Mr. Han, please.
Thank you, Amelia, for sharing. Now we'll invite Mr. Han, CEO and Chief Executive Officer and Executive Director of OUE Commercial REIT, to do a quick presentation about the company's business performance. Thank you, Mr. Han. Over to you.
Thank you, Zach. Good afternoon, everyone. Amelia, wonderful presentation. Thanks for that. Everyone, what I'd like to do today is I'd like to run through a little bit of background about where OUE Commercial REIT has evolved over the years, and to touch on what Amelia has mentioned earlier regarding the merger to create an enlarged entity. Then I'd like to focus a little bit about why I like our positioning as a REIT within the REIT space. Also to share what we've been doing the last 1 year and how we see the REIT evolving over the next this year and over the next few years. Okay. Zach has sort of touched on this. Essentially, the key takeaway for this is all our assets are located in prime locations, and predominantly Singapore. 90% of the assets are in Singapore, and 90% of the income is essentially in Singapore as well. With the one sort of key prime asset in Lippo Plaza in Shanghai on Huai Hai Lu. Okay, moving on. Now, the REIT started its journey back in 2014 when it was listed with two assets, OUE Bayfront and the Lippo Plaza. The REIT then grew from sort of 1.7 billion to 3.5 billion in 2015 with the acquisition of a majority interest in One Raffles Place. There was a need to grow the REIT at that point in time, and it was followed by a subsequent acquisition in 2018 of circa 900 million for OUE Downtown Office. So the REIT was at essentially 4.5 billion. Again, in 2019, it is quite important for REITs to be, to be of a certain scale. REITs, which are quite small, tend to suffer from a lack of liquidity, lack of institutional interest. So, the need was obviously to grow the REIT. So in 2019, we merged with OUE Hospitality Trust, and it became a much enlarged REIT. The REIT today is AUM is circa $6 billion. Now, what have we been able to do post that merger? Number one, post that merger, we were able to undertake a large AEI, which was to essentially take the Hilton Singapore Orchard off the market in 2020 and to do that extensive refurbishment. Happy to announce that we have now fully launched all our rooms. We have 1,080 rooms. It has been rebranded to the Hilton Singapore Orchard, and it is the Hilton's Asia Pacific flagship hotel. Okay. Now, previously, if it was in the Hospitality Trust, it comprised circa 2/3 of the income. So it was really very difficult to take this one asset out to do a big AEI. But with the enlarged REIT, the impact on income is naturally a smaller proportion of it. Now, the other thing we were able to do with the rebranding to Hilton was we were able to bring on a partner, which was the Hilton, and they're very focused on ESG. So they bring best practices, which we also adopt and can learn from. Subsequent to that, in 2021, we were able to undertake our first divestment in OUE Bayfront. So it was 50% divested to Allianz Real Estate and NPS, National Pension Service of Korea. So it was divested at a 7.3% premium to the book value in 2021 and a 26% increase in value from the initial value of when it was injected back in 2014. Now, with the enlarged REIT, we were then included in the FTSE EPRA Nareit Global Index. Now, why is this important? A lot of the liquidity is also increasingly being provided by index funds. So being included in the Nareit, the Global Index Fund, is an important step to improve the REIT's performance as well. And in 2021, we obtained our first sustainability-linked loan for the REIT. That was OUE Downtown Office. Now, very quickly on the portfolio. So as you'll see here, there is no asset concentration by a single asset. The largest, obviously, is the One Raffles Place with circa 27%. Similarly, the revenue profile, we're also seeing there's no concentration risk, the largest being One Raffles Place at 24%. Now, what is quite important, and I think this is a really important pie chart for us, is the one on the right. So I'll take a bit of time to share here why we really like it. So circa sort of 55% of our income is derived from office, and office tenants typically have 3-year or longer leases in place. So this part provides us a very nice underpinning of our overall portfolio. So this chart essentially shows a barbell strategy that we have in place. The office component provides a stable long-term income, and the retail and hospitality sector allows us to adjust, especially for the hospitality sector. It allows us to adjust the average room rates on a dynamic basis, whereas office rents are obviously a little bit stickier, where it's fixed for 3 years typically. Retail will also have a gross turnover component, which allows us to capture and benefit from the upside of inflation as well. So this barbell strategy, where we have one leg of it, they underpinned by stable long-term income, and the other bell basically allows us to benefit from any upside, whether that is inflation or any volatility in the market. We can adjust accordingly. So that provides us the delta which we're looking for. Okay, on valuations, last year was a very positive year for OUE Commercial REIT. Our overall portfolio valuation increased by 2.6%, and was driven essentially by the Singapore office assets. The OUE Bayfront, One Raffles Place, and OUE Downtown Office, we were able to improve our occupancy from circa 91% at the beginning of 2022, and we closed the year at 95.5% occupancy for the Singapore office portfolio. And we saw double-digit rent reversions as well for all three Singapore office assets. So we're in a position where we're quite happy with where the rental levels are. Obviously, the one sort of negative on the slide here is the Lippo Plaza. Now, we've seen values come off by 11%. Now, I have to highlight, out of that 11%, 10% is due to Forex, and the actual decline is 1% in a renminbi basis. Now, the strong performance last year of the Hilton, Singapore Orchard, and the Crown Plaza, Changi Airport, meant we saw a strong uptick as well, especially for the Hilton Singapore Orchard. I will touch on the Hilton Singapore Orchard a little bit later in the slides. Mandarin Gallery essentially has bottomed out with regards to sort of retail rents, and you'll see valuations stay flat there. So strong portfolio performance coming through. This essentially shows we again have a very well diversified tenant mix in our portfolio, and also we do not have any year where there's a large component of leases expiring. It's a fairly smooth expiry profile we have there. So the key highlights, we saw a revenue dip somewhat. So this is due to the deconsolidation of OUE Bayfront's performance. We had divested 50% of the interest in the property on 31st of March 2021. Now, if we move down, essentially, distribution had come off somewhat for the year versus the full year 2021, and a lot of it was driven by sort of two main things. One is the increase in interest rate cost and the cost of debt, and the second factor really is we had some leases. It was sort of a timing thing where some leases were actually renewed, and they were actually starting a little bit later than we actually had initially budgeted for. And some of these new leases with higher rents are starting 1st January this year. So slightly sort of longer void period in that decline. Okay. Now, this is, we're very proud of this slide. We did a lot to reposition the REIT previously. In the last 1 year. So previously, the REIT had a majority of the debt being a secured debt. Now, what that means is it doesn't allow the REIT to tap into any debt headroom in a flexible and efficient manner. It also, so our objective last year was to change this and to move it across. So we did two things really. We felt the timing was correct to issue a bond last year. So we were concerned about the bond, about the Fed increasing the interest rates. So we knew the Fed was sort of looking at very likely to increase the interest rates on the 6th of May, FOMC. We caught a very small window in April to issue a note. Most of January and February, the Singapore dollar debt market was closed. Now, we launched on the 25th of April. It was $150 million bond at 4.2%. Now, it's the first bond issued in Singapore with a coupon step down of 25 basis points upon the REIT achieving an investment grade rating within the 18 months of the issuance date. Now, as you will see, interest rates did subsequently move up by quite a fair bit. So we're very happy we actually did lock that in. Now, the only thing was we wish we actually had done a bigger bond issuance at that pricing back then. Again, the concern was, we'd seen sort of, if we move fast forwards a little bit, we'd seen sort of interest rates go up in May. And coming back to what I mentioned about moving from a secured to an unsecured debt component for the overall REIT, we launched in June. We launched a very large refinancing. We were quite concerned of the refinancing environment with interest rates coming up, sort of ticking up very quickly, plus potentially an economic slowdown in towards the end of 2022 and in 2023, making refinancing potentially more challenging. So we basically were able to successfully secure a $978 million sustainability-linked loan, our second, and this was the largest sustainability-linked loan among all S-REITs to date. Okay, what that has done is that has moved the overall portfolio unencumbrance to 70% from what it was previously of 30% in terms of debt being secured, moving to unsecured debt. And we also were able to refinance all our refinancing for 2022 and 2024, and also a part of 2023, leaving only a very small component left in 2023 for this year. Okay, with regards to sort of our average gearing levels, it is at a comfortable level at 38.8%. Our total debt has also declined slightly from the September numbers. Our weighted average cost of debt has increased a little bit to 3.4%. Now, the overall sort of interest rate environment keep moving up. We are keeping a close eye on it, but we are we're quite comfortable because we have 71% of our debt being hedged. So we are able to cap the full sort of impact of the rise in interest rates. Our interest coverage ratio is comfortable at 2.6 and adjusted ICR at 2.5 times. As I mentioned earlier, we only have a very small 273 million this year and no refinancing due for 2024. So very, very little refinancing risk here. We recognize there's a debt maturity wall in 2025, 2026. We're working on smoothing that out as well. Okay, key improvements I've touched on earlier. So Singapore offices occupancy was high at 95.5%. And as I mentioned, we have positive rent reversions with double-digit rental growth in place throughout last year for all our office assets. We also looked at cost of providing services, utility costs all increasing dramatically last year. So we're passing that through as well this year by implementing an increase in service charge on the 1st of January for all our Singapore assets. On the hospitality side, we're really happy about the performance of our hospitality asset, especially for the Hilton. When we opened last year, the first wing with 634 rooms, our average daily rates were 300. It had very quickly moved up to 400 in April, and from May onwards, it was hovering around the 500 average daily rates. Now, as a comparison to pre-rebranding, the previous Marriott Orchard Singapore was average daily rates at the best of, at the best of times in Q4 2019 was hovering between $270 to $280 per room night. Now, as we've seen, it has nearly doubled, and the performance this year has, February has been strong. So we are very positive about the performance of our hotel assets. For the retail, the Mandarin Gallery, we had a 10.4% rental reversion. We've also been able to convert some of the short-term pop-up leases we had in place, or we either sort of changed them over to new and permanent leases, or we brought in other retailers. Now, shopper traffic has improved to circa 95% of pre-COVID levels. However, tenant sales do remain slightly lower than pre-COVID sales at 85%. But we see with the reopening of China, potentially, we can pick this up this year. Okay, we've touched on this. Probably just showing it through the pictures. This is what we've been able to do, and one of the main things we were able to do was we were able to include and expand our MICE offerings. So currently, the Hilton Singapore Orchard has the largest MICE facilities along Orchard Road, and one of the key features here is we've basically done it up in a way that it caters for hybrid events. So we have 3-way cameras in place for all the rooms. So what does that mean? That means when you dial in, if you're dialing in from an offsite, you will be able to see both the speaker and you'll also be able to see the audience which is participating. So that provides for a more enhanced and inclusive experience for hybrid MICE events. Okay, moving on. ESG is a big part of our journey. We understand it is a journey and it's a long way to go, and it will keep evolving. So a few key highlights here. Now our sustainability linked loans account for just under 60% of our total debt. We have started adopting green leases, and as new leases are coming up, we're inserting, we're changing them over to be green leases. And they are now accounting for 21% of our leases, our net lettable area in Singapore. We've also participated in GRESB. It's a real estate benchmark sustainability index, and that will help guide us along our journey as well. We also believe in human capital, and we also believe in our people. A lot of what we can achieve is really a function of how talented and how good our people are. So that means treating everyone with respect and sort of being really fully supportive of them growing and improving their skill sets. So we had an employee satisfaction survey. It was a high score of 91%. A large proportion of women are in our senior management and also our REIT. We are focused on continual learning with a minimum of 25 hours of training per employee. On building trust, corporate governance, that is the key to engaging properly with all our stakeholders, including institutional investors, retail investors, the regulators. So we're happy to share that for the gift index. We've improved by 6 positions to 28 out of the 44 REITs, and we are we're ranked at 32 for the gift index. So looking ahead, what are we looking at? So three key pillars. Number one, we're very much focused on asset management and tenant engagement. So essentially what that means is we're trying to optimize our rents, and also the focus this year very much is on maintaining the high occupancies across our assets. We also constantly looking at ways to minimize our operational expenditure and through the use of technology, improved materials, etc. Okay. We also recognize, not just trying to improve occupancy, pushing rents up and managing costs. We do need to look at, what else we can do to improve the overall value of the asset. So one of it is asset enhancement initiative, which we has successfully completed for the Hilton Singapore Orchard. We're now looking at all our other assets to see what else we can do to improve them. Obviously, last year we were also looking at overseas acquisitions in the key markets of Australia, Sydney, Melbourne, and also in London in the UK, very much in the commercial office space. With where interest rates are and with yields in these locations expanding, but not quite at the level which we're comfortable to start acquisition in an accretive manner. We're still monitoring the market, but we're not rushing to do it immediately. Divestment opportunities, we take that on a opportunistic basis. Again, if we do divest, we're looking for it's not just at divesting, but at also what we will do to recycle that capital in a positive manner. The last sort of pillar, which is a very critical pillar with where the cost of debt is today, we're looking at how we manage our relationships with the banks. We're looking at the key times to refinance our debt and also to issue new bonds. We're looking at that very closely. And as you saw in the earlier chart, we were able to time it and anticipate the increase in interest rates, and get ahead of the curve with regards to where interest rate environment will be 6-12 months ahead. So we're happy we did that last year, and we will continue to apply the same discipline this year. Thanks, everyone.
Thank you, Mr. Han, for the insightful sharing. We'll now move on to the Q&A session. I'd like to invite Benjamin, Head of Research and Investor Education from SIAS, to moderate this session. Now, participants, you may input your questions in the Zoom Q&A function below, and our Facebook audience, please click on the link in the description box to join us here to post questions. We'll try to answer as many questions as we can within the short time. Now, over to you, Ben, to take over the session.
Thank you very much. So very warm welcome to Mr. Han. Very grateful for you to be able to join us. We've had a couple of pre-submitted questions regarding the funding model as well as your business model. So we're going to start with that. And then as you may have already seen, quite a few questions coming through the Q&A function in our Zoom. Yeah, hang on, my Zoom is kind of acting up here. All right. Okay. So let's start with the pre-submitted questions. So you had a slide showing the FY 2022 key highlights, the strengthened capital structure. So very impressive improvement in terms of the percentage of fixed rate debt. Sorry. The question was, what is the current ratio of OUE Commercial REIT?
Sorry. Hi. Good afternoon, Ben.
Hi.
Sorry, the current ratio.
The current gearing ratio.
The current gearing ratio, we're at 38.8%
As of
we're at 38.8%.
Oh,
yeah,
okay.
So we're comfortably below 40%.
All right. So that's the leverage, aggregate leverage line. Yeah.
That's correct.
Okay, good. So I'm just going through the check boxes. These are the typical questions that
Yes.
for REITs. All right. Okay, the next one is, I guess we can move on to the questions that have come through surrounding the, I guess, the business model. So there are quite a few questions about the strategy and opportunities regarding the different asset types, segments, as well as geographies that you have. Would you be able to add a little bit more color as to what is the strategy going forward for all these various different segments and geographies?
Okay. Singapore is very much a focus for us. We are looking at the key markets of London, Sydney, and Melbourne, and very much in the commercial office space. Yeah. I think it's important to understand, actually, we do believe even with hybrid working, there's a need for prime core office space. Okay. Why do I say prime core? When we've seen during the COVID, post-COVID, a number of employers have been trying to get people back to work, and employees are also choosing whether they would like to come back to work or they would rather work from home. So one of the key things of getting people back to work is a nice working environment, and also the location, right? For instance, in Singapore, if you're living sort of on the suburbs, Previously, if you had a hub and spoke model, it sort of made sense to drive 5 minutes or 10 minutes to work instead of coming to the CBD, which may take half an hour or an hour to do that. And they'll be close back and forth to work on a daily basis. But now with a lot of employers allowing sort of 1 or 2 days work from home, or some even up to 3 days work from home, a lot of employees find that they would like to, they don't mind traveling further, but when they do come in, they want to be in a location which provides them a lot of amenities. So it's a place where they can go do a yoga after work, they can go watch a movie, they can go for good F&B, meet up with friends. So that whole overall experience becomes quite important because they're only coming to work 2 or 3 or maybe 4 times a week. So it's not the previous sort of 5 days. Now, why do employers need people back at work? Is it fosters collaboration, and a lot of the equity that was built into during sort of pre-COVID was used up. So a lot of the relationships were built pre-COVID, but during that COVID period where there was very little personal interaction, a lot of that was diluted. Now, there's a need for organizations to start building that, and a lot of the senior management recognizes that. And they recognize that, if it's just processing paperwork, a lot of staff can do it at home. They don't need to come in. But what that means is we are not seeing offices decrease in the space. We're seeing them change the composition. Previously, where there was maybe 20%, 15% meeting rooms, and the rest are workstations, we're seeing it swing towards maybe 40%, 50% workstations, and an increased component for pantry, collaboration space, etc. Sort of a more sort of collaborative work environment. So we're seeing that. One of the sort of strengths of our portfolio is the key locations. It's in Raffles Place, it's in Bayfront, it's in downtown. So during times of, we saw during times of volatility when COVID struck, they held up rents and occupancy fairly well. And last year, when the market was really strong, we also saw rents and occupancy pick up very quickly. So that's one of the key strengths of our portfolio. It benefits from both, down sort of when it's a sort of risk off environment and when it's a risk on environment, and when the economy is doing well and not doing well, we're still benefiting during that period. So we believe in the commercial office. We believe in Sydney, Melbourne, and the UK because they provide 5-year, 10-year leases. So that allows us to increase our weighted average lease tenure as well, and it strengthens the overall portfolio.
Okay,
so
thank you very
yeah.
much for that. Certainly coming into the office and get a whole day free aircon is kind of nice. A bit cold actually, but saves on electricity back home. Just now you touched on your property in the CBD area. Specifically, there is a question about One Raffles Place. Would you be able to add more color as to what are your growth plans for that particular piece, for that particular property?
Growth plans, we've been aggressively sort of nudging our rents up in that area. Last year around this time, we were signing rents in the sort of mid-9s to mid-10s. We're now signing rents in the sort of high 10s to 12 range. Really, that's so we've been able to push that up. We're increasing service charge. For the retail mall, we're looking at bringing in new concepts to improve the overall offering. Okay.
All right. Great. The next question is about the dividend paying policy. So the question is, going forward, given the changed economic reality globally speaking, what would you be able to add more color regarding the dividend payout policy?
Dividend payout policy. We have not changed our dividend payout policy for years, and there is no plans to change it. We're still essentially paying out nearly most of our income. Obviously, we retain a certain portion every year for working capital.
Okay.
Yeah.
All right. Okay. A different question. about prudent capital management. What is the risk and rationale of increasing the unsecured debt to 69.4% as of end of last year?
Okay, so so unsecured debt is a very good thing to have. Okay, for a REIT's perspective, which means we are not pledging the assets to the banks. Okay, so the banks are lending us on the strength of our portfolio, as opposed to as a retail sort of person on a personal note, when you borrow from the bank to buy your home in Singapore, you would have to pledge that that home to the bank. So the bank has rights over it. Whereas in this case, what we're trying to do is basically we're trying to remove that mortgage of all our assets. We just have one left, which is OUE Downtown. So all our assets are basically unencumbered. And by doing that, it means we can go and talk to the bank and we can say, look, we still have headroom and we're looking at doing some AI. We need 50 million to do AI, or we need a 200 million facility, a short-term facility to acquire an asset, let's say in Sydney, for instance. If it was encumbered, we would then have to go and talk to each bank and say, hey, can I tap 10 million and 10 million for this asset, 10 million? So it's quite cumbersome just trying to do that. And most banks say, no, we're quite happy here, so we won't let you tap that, which means we have very little flexibility. But if you're borrowing off an overall portfolio, the banks are saying, okay, I'm not lending you money on one asset, I'm lending you money on the whole basket of assets. So they get a little bit more comfort, and it provides us more flexibility, and hopefully it helps us reduce our overall cost of debt as well.
Okay. All right, thanks for that. Okay, the next question is again back to One Raffles Place, and I suppose this person works around here. So the question is this: what is the occupancy rate of the retail portion of One Raffles Place? This is because there seems to be quite a lot of empty shops.
Okay, we are currently at circa 85%. We're circa. Yeah, so that's where we are now. We have sort of a slightly larger space on the 5th floor, which used to be the old food court. That's circa 10,000 square feet. Now we're looking at a few different concepts to bring a tenant in. Obviously, we want something which basically sort of improves the overall experience. With regards to, I mean, if you're walking through the basement one, etc., there are some sort of there've been some changes in tenants, and which feels that their concept don't work, and we're in the process of we've brought on quite a few new tenants as well to improve the overall mix of the One Raffles Place.
Okay, if memory serves me well, a lot of these shops are eateries, right?
But F&B does F&B does well, and it's really very much what the consumers want from a One Raffles Place. We've tried clothes, we've tried sort of fashion, etc. So fairly limited sort of demand for that is our experience. Services, for instance, repairing shoe repair, mani-pedi, things like that work really well. So but the bulk of it is essentially F&B. Yeah.
Okay. All right. Okay, good. All right, back to the numbers. Another question that came through from the Q&A function here is that the interest coverage ratio is 2.6 times. So from this person's perspective, it is relatively on the low side as compared to the peers. So our comment was that perhaps the REIT could consider powering down debts or improve the revenue side of things.
Yeah, so we are conscious of that, and that's what we've been doing since the start of last year, really. Hence the large refinancing and moving from secured to unsecured, that allows us to eventually bring our overall cost of debt down by being proactive and tapping the market at the right point in time. For instance, if you look at this chart on the left, the bottom left, we did secure bond, 150 million bond at a 4.2%. If we were to do it today, it'll probably be 150 basis points more. So assuming it's 150 basis points more on 150 million bond, that's circa 2.25 million in interest cost savings a year by doing it earlier and preempting the market. So these are the type of things that we try and do to make sure we keep paring the cost of debt down. And we pushed really hard last year on the rents as well. Hence, we've seen OUE Bayfront, we were signing rents in the 14s and 15s, which are market leading rents. And One Raffles Place, we've seen, similar increases, and same for OUE Downtown. And we've also started filling up our occupancy from 91.1 to 95.5% for our Singapore office portfolio. And the objective this year is to maintain similar level rents, maybe not push them so much, but to really try and improve the occupancy another 2.5 percentage points for this year.
Okay. I guess one last question, since it's right about time. And I probably missed this just now, but you mentioned in your presentation that you had a 50% divestment from one of your property. Could I ask what are the plans regarding the funds raised from that divestment?
Oh, that we used a portion of that to pare down our debt. Really. So that was a key move as well, because pare down part of that debt, because in 2020 we announced the start of our $150 million asset enhancement initiative for Hilton. So we had to pare that down because we're incurring additional costs to improve the Hilton as well. Okay,
that makes sense. Yeah. I kind of like the hotel as well, but it's good to spruce it up once in a while.
It is.
Right.
It is. Yeah.
Thank you very much, Mr. Han. Very grateful.
Thanks, Benjamin,
for taking your time to answer our questions. Again, we don't usually get, to be quite honest, CEOs of large public companies spending their time with us. So very happy that you managed to do that.
Happy to do so. Thanks a lot, Ben.
Hopefully we can see you more of some of our events. I'm sure our viewers will be happy with that as well.
For sure.
All right. Thank you very much. Over to you, Zach.
Thank you, Ben. Thank you, Mr. Han, for going through all these questions and answers for the benefit of investors. We have now come to the end of the session. Thank you, everyone, for joining us this afternoon. In case you have missed any part of today's session, you can rewatch the webinar on SIAS YouTube channel. Our Corporate Connect webinar is actually a bi-monthly session that you can find out more on our website and get updates on our upcoming investor education programs and initiatives. The next Corporate Connect will be featuring UOB Group on the 14th of March. So please come and join us if you do have the time. Once again, thank you, everyone, and have a great day ahead.
Thanks. Thanks, Zach. Thanks, everyone. Have a good afternoon.
Thank you.